Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. While markets are trying to assess when rate cuts will begin, there are multiple of things which are keeping markets busy. The US Treasury cut its quarterly borrowing requirement to $760 billion from a widely expected $816 billion. Smaller requirement would mean lesser issuances of bond, but whether this is significant is of course something JK will share. Apart from this, we have been seeing good rally in global equities. Currencies have been ranged, and geopolitical risks are still lingering in the background. Good morning, JK. The cut in quarterly borrowing, what's your take on it? Is it even significant?
Good morning, Swaraj. Yes, a $55 billion lower than October estimate on the borrowing. That definitely gave a push lower to the yields. But I would think that is only a short-term factor. But if you look at the overall deficit, fiscal deficit that the government is running, and also the huge amount of debt that's going up. Some calculation indicate US debt increases by 10 billion a day. So that's kind of 3 trillion increase in the next 1 year. So one wouldn't be too sure that these yields can be so easily managed, can remain lower, or the borrowing can be lower, considering the amount of funding that the government requires. But I think we really have to look at two things: how the actual borrowing pans out, whether it sticks to the estimate, and also whether how it will be for the coming quarter. Currently, this downward revision is based on the huge treasury balance of about 750 billion that they are holding, that it is helping them to give lower estimate. And apart from that, oil prices also eased yesterday. This is after not much of a response from the Western allies to the attack from the Iran-backed militants, which killed 3 soldiers over the weekend, and some sort of pullback in the oil also led to the yields coming off yesterday. In fact, the yields had started to come off last week after the GDP and PCE inflation data. Yesterday, 10-year eased by 7 basis points and 30-year eased by 6 basis points. Even as March rate cut, the probability is still below 50, although the market is discounting still 1.5% decline in rates by the end of 2024. We had another good performance by the equity market, of course. The global equity index gained 0.67%, but the US markets, particularly the tech sector, outperformed again by 1.07% gain, and the S&P gained for the fifth time of all-time closing high. So very impressive, and these moves are already discounting a good number from high-profile tech companies. Starting today with Alphabet, Microsoft, Apple, and Amazon. These are some things that they are looking forward to. But on the other side, the Chinese index, which had gained 5% in last 1 week, particularly after they cut the RRR, the index has lost about 2% since yesterday, after a court in Hong Kong has ordered the liquidation of a debt-laden Chinese property giant Evergrande. And the key is whether the Monday's ruling will be followed in mainland China, which has a separate legal system. While Evergrande shares and dollar bonds are traded in Hong Kong, the bulk of its 242 billion of assets are located in mainland. So the final, decision whether it will be implemented by the mainland will decide the fate of the creditors of Evergrande. And right now, market is not really reacted to this news so much, but China has definitely reacted. The dollar is gaining back gradually due to indications that Europe may cut rates at least by June, going by statements by some of the ECB members yesterday. Although something, even an April move is not ruled out. Yesterday we had indicated, the sources of Reuters saying that a cut in June is possible by ECB, and next meeting they will be discussing about the rate cuts. Now this has also seen the euro lose out. Again, not only dollar, but also against yen, because the euro yen has been on a big upswing for several months now, and that's seen Now that's being corrected. Yields falling has also seen the yen post some gains overall, while GBP remains, kind of in a neutral range until more indications come about their rate moves. We kick off a slew of data today in the run-up to FOMC announcement. Tomorrow, we have the Conference Board's Consumer Confidence Index, and also the December JOLTS data, that is job openings and labor turnover survey. And these are followed by the ADP numbers tomorrow and Challenger job cuts day after tomorrow. All these are, build up to the monthly jobs data that come on Friday. So each number will have to be closely looked at in an overall scenario to see how the job market in the US is performing. Of course, well before that, we will have the FOMC decision as well. So what Fed chairman is going to say and what hints we can get about the timing and the extent of rate cuts in the absence of the dot plot this month is what will determine a lot of moments in the market. Coming to our own rupee, market traded the currency in one of the tightest ranges for a long time, not inclined to push it either way against the natural demand and supply. It was one of the quietest session I have seen on a day when monthly settlement in future and option sections was concluded. But in the sub-year, we are into slightly more volatility because we face the Fed rate decision, then it will be followed by budget immediately on Thursday morning. So while there are looking at the budget itself, while there are sector-specific expectations from the vote on account, as far as the forex market is concerned, I will look at a few factors like whether there are proposals that lead to more foreign fund flows, whether government betters the fiscal target of 5.9% for FY24, and what it will target for FY25. What's the level of government borrowing likely to hit the market in the coming fiscal to fund the government's deficit, and measures that will aim to boost consumption and investment, which will eventually further cement our superior growth rate for long term. So these are the factors that the markets will consider, both stock market as well as the currency market will consider from day after tomorrow's budget proposals. So long as possible socialist and populist measures don't worsen the deficit, it will be well received and remain neutral or somewhat positive for the rupee. But at least for today's session, I expect another quiet session leading into major data starting tonight and tomorrow. Thank you.
Thank you, JK. And as you mentioned, I think first Feb is going to be a very busy day for you as we have got a lot of events lined up. We'll also have the FOMC result and the budget and everything. So first February is definitely going to be a day when possibly markets can move and we can get some bit of volatility. Just quickly summarizing today's commentary for the US, the lower estimate of borrowing for the quarter did push the yields down, but it's possible it's a short-term phenomena as the overall debt for the US has been increasing quite significantly. The rally in tech sector has been the theme for the US equity rally, as it is expected that the tech sector will post better earnings. And in China, a Hong Kong court has ruled the liquidation of the Chinese company Evergrande. The main thing to observe is whether this would be followed in the mainland China, as that's where the company's main assets are. Um, and of course, with respect to data, we'll have a lot of US data with respect to the labor market, which should give us indication as how the labor market is doing. And for the rupee, we were in a very, very tight range, especially on a day, as JK mentioned, when futures and options were settling. So it was a very low volatility day yesterday. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.